Good evening, everyone. I am CA Rakesh Kumar Singhal, moderator of this webinar. We are delighted to welcome you all in the webinar being organized by Continuing Professional Education Committee of ICAI. It is my pleasure to be moderator for the 90th webinar on Startup in India 2026, Tax and Regulatory Primer, and Compliances under the Code on Social Security 2020. In a short while, we will start this webinar. First, I would like to apprise you about CPE committee. The profession of chartered accountancy is growing leaps and bounds, and its phenomenal growth has brought the profession at the forefront. Today, our profession has acquired an indispensable position in the business and economy. ICAI continuously aim at developing knowledge as so that the members stand out to the expectation of the society. To achieve this objective, the CP committee of ICAI has been continuously striving for perfection, integrity, and knowledge, which make the word chartered accountant synonymous with excellence in service. In this direction, CP committee has always been proactive to the emerging need of its member, enabling them to acquire contemporary knowledge and skills to face the challenges effectively by organizing CP program and providing adequate opportunities. The program for this evening is as follows. We have two sessions of 1 hour each. Topics are Startup India 2026, Tax and Regulatory Primer, Compliances under the Code on Social Security 2022. Our eminent speaker will talk about above mentioned two emerging areas of professional interest. We now move to the first technical session on the topic Startup in the India 2026 Tax and Regulatory Primer. To deliberate on the subject, we have with us CA Ishank M. Shah from Mumbai. I am reading his biodata for your reference. CA Ishank M. Shah, he has over a decade of experience and leads the startup transactions and funds practice. He has also advised 400 plus startup institutions, investor on venture capital transactions, valuation, and alternative investment funds. He is a trusted advisor to leading VC and angel funds in India and has contributed to the startup ecosystem as a knowledge partner for Shark Tank India Season 1. His expertise spans venture capital, fund structuring, valuation, regulatory advisory, and corporate finance. I request Ishank M. Shah to kindly take over the session.
Thank you, Rakesh ji. And thank you, Siddharth. Good afternoon to everybody who's joined in, and again, gratitude to the Institute that is organizing a lot of these learning and session events for all our practitioners. I'm going to share my screen today. We have roughly 60 minutes, but on something that is continuously growing in India. Let's say at ICI, we are celebrating the 90th. I was just understanding from sir, this is the 90th session, and this is going to be almost 10 years plus that India began its Startup India journey, if you could say so, back in 2015, 2016, when our Prime Minister began the Startup India initiative. I think my screen is visible, so everybody should be able to see what we have for today. But the objective or the idea over next 45 to 50 minutes is twofold. Firstly, just a quick introduction to our ecosystem, what's been happening factually and realistically in the last few years, and 2026 now that the year is started, what we can look forward to. The tax and regulatory stack, and stack is a startup ecosystem word. We typically call it technology stack. Some people call it the digital stack. And so we are saying this is the Startup India stack. So it's, idea is to familiarize the audience with some of these words or jargons which are also used in the ecosystem. So tax and regulatory, the second bit, and the professional opportunity, that lies for us as chartered accountants, as professionals, to engage with these companies and in some way provide professional services that can enable their growth and us become participants of their growth. So just with that flow, the first slide is primarily to cement our position as world number 3, just behind US and China, the first and second countries, the largest ecosystem, and the most active incubation or acceleration program that exists in India. Incubation or acceleration are primarily early stage partners who work with some of these startups and to help them give them necessary support or market access or infrastructure that would help them grow. Startups always come with limited or limitation in resources or limited resources, and therefore any sort of help that gets them and their business going is something that they're looking forward to and engaging with. So in terms of incoming investments, we're nothing short. We were last year closing at roughly $160 billion. And this is even plus as a number that keeps growing. 1,000 almost incubators, accelerators. The number of startups registered with DPIIT, please bear with me. I had some limited time on this presentation, but 184 by now should have crossed 2 lakh plus startups. So as a first area of practice, what you see here is registration with Startup India. No harm, no loss, and no cost registration for any particular company that would fulfill the criteria of startups. It's the first opportunity for professionals to start engaging with such companies on. Where would you know about all of this? startupindia.gov.in. So you see that on the right. It's the website where the government is pushing all of their policies, plans, the applications for startups, and everything that is part of the startup ecosystem. It also has within itself state-specific policies. So while you are practitioners throughout India, each state is also contributing to the startup ecosystem in some way or the other. And there are within each state specific policies that could add up to the central policies which the government is promoting. 121 unicorns, even higher, anything more valued more than 1 billion US dollars is what is called as a unicorn. And those are again constantly growing in India. So this was just information. It's that the fact that it's as a trajectory been only growing over time. In terms of sectors, as you start interacting with some of these companies, one word that frequently comes is what sector are they in? What are they doing? Are they doing something in fintech? Are they doing something in e-commerce, in enterprise, in clean tech, in deep tech, which is AI / a lot of other detailed things within AI, consumer services, logistics, media, education, technology, health, travel, agri-tech. So these are some sectors. Deal counts, funding amounts are largely related to valuation related or deal making business, but the idea is to familiarize yourself with newer sectors of business versus how they have been traditionally running. From a timeline perspective, like I was saying, we now celebrate the 10th year in 2026 when we began the concept of Startup India, where the definition of a startup was first introduced. So the government in 2016 made the notification and said any company that is not older than 10 years from their incorporation or turnover that does not exceed 100 crore, second criteria. And the third criteria over here is they have to be some employment generating, wealth creating, or doing something that is innovative or developing in nature, and the business needs to be scalable. The third bucket that you see on the right is more subjective, and there is no criteria as to what would be defined as innovative, development, or scalable. As long as you're able to demonstrate what you're doing is different or an improvement of something that is already happening, you are good to go with the bucket number 3. And turnover of less than 100 crore in 10 years are both factual numbers. So a company, an LLP, a partnership firm, you see here on the left, the 3 points. Any of these in these three buckets would be eligible to be recognized as a startup. The process next would be to go online on the startupindia.gov.in website and begin your application process, and where you as a chartered accountant can start an immediate engagement with a company that comes to you, which has been newly set up and looks forward to becoming a larger organization. What is not qualifying for a startup is a company that is formed by splitting up or reconstruction of a business in existence. So please avoid anything that is demerger, merger, subsidiary of a foreign multinational, or just a carve out of an existing entity and does nothing different, absolutely nothing different from an earlier entity. So these are your negative lists, and these companies technically do not qualify to be recognized as an eligible startup. So within this being the first matrix, which is what would qualify to be an eligible startup. Then began the journey of this particular definition being revised from initially began with a turnover criteria and a time criteria which was far more lower. The time has gradually increased from 5 to 7 and from 7 to 10 years, and the turnover limit has been up to almost 100 crores. The Startup India program also introduced what they called a Bhaskar initiative. You will see that on their platform online. So primarily a platform to centralize learning and collaboration between stakeholders. So there are startup advisors, there are investors, mentors, government bodies, service providers, all who are able to work together under the larger Startup India ecosystem. So that Bhaskar initiative is also something that the government is initiated. What happens once you apply? Once you would apply and the application process, let's say we would look at that first, asks you certain questions which are largely around what is the particular startup doing, how does it generate wealth or be innovative or create employment, a brief note on what you're doing, on what is being done, certain KYC information, mobile number, director, DIN number, email IDs, etc. What is the problem that you're solving? How do you propose to solve that problem? What is unique? A pitch deck. You see that serial number 12. Pitch deck is a word that is primarily used as an investment presentation, videos, socializing content. How do you generate revenue? So there's an exhaustive checklist. It's followed by what is IP and what are your current stage at which you are in the business, ideation, validation, traction, scaling, and answering these questions online and submitting this application. Let's say once this application is submitted, you would then be waiting for roughly 10 to 15 days by when the Startup India portal should write back to you with either clarifications or B, straight away with a copy of the Startup India recognition certificate. So anything between 2 to 3 weeks you can assume as a timeline to get your certificate in hand, subject to any queries that come up as part of your application process. There's a centralized ID that you can refer to in case things are delayed. There's a toll-free number. In our experience in past, we've actually written to them. They're responsive. We've called them. They do answer calls. And therefore, it's something that is useful to get your application completed. Now that the first Startup India recognition element is achieved, there is a common misconception, or let's say a common marketing understanding that all startups are recognized, that all companies are recognized as startups also enjoy a tax holiday. A tax holiday primarily of not paying tax for 3 out of 10 financial years. Now, it's not as straightforward as it is from a legal or technical standpoint, and we and as professionals understand this very well. The first recognition, the Startup India recognition, is the pillar. It is easy to get. It's an independent application. You have roughly 2 lakh plus startups that have got this registration. It's completely online and it's through this application process. But this does not guarantee you the tax benefit. In order to obtain a tax benefit, a second and separate application needs to be made. This is again online on the Startup India portal itself, where you would apply for what is called the 80 IAC registration or the Inter-Ministerial Board recognition, the IMB recognition. And here the benefit is obviously of getting a tax holiday for 3 out of 10, 3 consecutive financial years out of a period of 10 financial years. So that is the first benefit. The criteria or eligibility for this is same. You need to first have become a startup. That's the first barrier. Once you've got that registration, then you should have been incorporated after 1st of April 2016 and before March of 2030. There's enough time. All companies coming to you typically would be qualificants for this. Third, that you should not be a split up, reconstruction, not a demerger, merger, etc. So not that of a company. And fourth, that any machinery, plant and machinery or assets that you own must not be something that is transferred from another existing entity. So that's the criteria in terms of qualifying for this. From our practical experience, it has been, it is better that companies that have a track record of anywhere between 2 to 3 years and have profitability do apply for this, and not necessarily just an immediately newly set up company, because the track record or information is not available for a company to apply for. So the application requirements are the 3-year historical financials and tax returns, followed by pitch deck, business models, other additional information. But the fact that if a company is only set up 1 year before, there isn't 3 years historical information. You could always self-declare that it's less than 3 years and hence you don't have that info. But the chances of you getting this then are significantly lower because you pretty much don't have information to supplement your application. This success rate of getting the interministerial board recognition is roughly less than 1%. So out of the 2 lakh startups which are recognized, roughly even less than 2,000 startups today have this recognition, the interministerial board recognition or the tax exemption. So one care is that the success rate is as low as 1%. Going into early is not, it's allowed, but your chances get lesser due to lack of complete information. Becoming or being profitable or having paths to profitability and couple of years or 3 years of financial history to show and business to prove gets you a better chance of landing this interministerial board recognition. Other than that, there are no stringent criteria. You have to be innovative or employment generating or wealth creating, all of which or scalable, all of which are something that you can demonstrate as a business once you are in it for 3 to 4 years or longer. There is a committee, a technical committee of 3 members from 3 different committees of the government that review these applications. They publish their minutes on the website of Startup India, and this application takes longer to get approved because of obviously the benefit that is attached to it. So you should expect a few months, maybe anything like 4 to 8 months for your application to get a response on. By the time the committee evaluates these applications, gets back, maybe seeks again clarifications, and then through the back and forth either get it or not get it. In most cases, committee ends up rejecting these applications for grounds that they do not believe these to be qualifying enough for the interministerial board exemption or the startup tax exemption. So this is firstly the benefit that is available to just allow me to mute. Yeah, the benefit that is available to a company that gets the 80 ISC exemption. Now, one important point that follows with the interministerial board exemption or the 80 ISC exemption is section 115BAA of the Income Tax Act. So you see that below. I will just again move the screen around, which is that the section today, the 115BAA section, once opted for, does not allow for any section 80 benefits apart from identified deductions, 80JJAA and a couple of other ones. Those are allowed. So basically the section therefore says that you're not entitled to any other benefits, and therefore this 80 ISC gets left out. Now, this can be a legislative oversight. Some representations are made in the past, but not that it has seen some result. So where companies have opted for 115BAA, this particular benefit is not being made available to them because they're not entitled to claim 80 ISC because they've claimed or opted for 115BAA. So again, from a practitioner standpoint, the ask is to be careful with your companies when they come to you. If they are making losses, there's no question of trying to opt for 115BAA. So continue to be opted out. And should they become profitable, maybe pay a year or two of larger corporate tax and give this application a chance so that you're not, so that when you're able to claim the 80 ISC benefit, should you get it upon application. So not applying for 115BAA is, or not opting for it is critical element of continuing to enjoy the benefit of this exemption once received. So it happened to us that we had startups, we got the exemption, and they were profitable, and then we started the computation process, and it is there that we got stuck because we understood that 115BAA blocked the 80 ISC benefit. But there's one learning, wish to share that with all of you so that and across all your clients are able to tell them the right way to take it forward. Apart from just the tax benefit, the 3-year tax holiday, this interministerial board exemption, the IMB exemption, has further benefits. And again, at the cost of repetition, this is not available for a basic startup recognized under the DPIT. There are 2 lakh startups. They have other benefits, which I will cover in due course. But the 80 ISC tax related benefits, one being the tax holiday, and then these are the other ones. These are quickly better to now, just to quickly address. Firstly, tax deferment on ESOPs. So ESOPs are typically taxed at exercise, but if you have an 80 ISC benefit, you can extend the tax issue to the tax liability to up to 5 years from the time the stock options have been exercised, or sale or leaving of the company, whichever happens to come earlier. Second is no angel tax, but as a section, it has itself been deleted, so no longer relevant. Third is capital gains tax. So if you were to sell a particular residential property and invest that money into this startup, an 80 ISC recognized startup, you have capital gains exemption. Fourthly, set off and carry forward of losses. If the shareholding were to change by more than 51%, there's a tax provision that says that all losses will be lost. However, where there is this particular event of getting a benefit of 51, a change in shareholding by more than 51%, the losses can be carried forward as long as those shareholders continue to be shareholders. Shareholding can change. And lastly, the 3-year out of 10-year tax holiday. So these are the additional benefits for an 80 ISC recognized startup. So what if you are not 80 ISC recognized? You are called what is called an eligible startup. And apart from that, you have these other benefits. So under the company law, you are exempt from cash flow preparation. Board meetings also are now relaxed. You can do up to 2 board meetings per year instead of 4. You could accept loans from your members without limits. Otherwise, there are statutory caps under the company law. Those do not apply for startups. Sweat equity and ESOPs can be given to founders, again, which is not available to a usual company, but available to a startup. Convertible notes can be issued by a startup. Now, this is a very different instrument. And this instrument primarily allows you to raise capital without the discovery of valuation. So that's what you call a convertible note. And the option for conversion lies with the holder or with the startup. And 2, if things don't work out, even this convertible note can be as good as redeemed back. So it's acting like a loan with an option to convert into equity, but structured as a convertible note and a recognized instrument under the company law, so that any private placement or other formal processes for issuance of securities can follow. There is a minimum tranche ask of 25 lakhs and from a single investor. So you convert the notes for 2-3 lakhs, you need to do a minimum tranche of 25 lakhs. Under FEMA, you have the flexibility of issuing this convertible note Otherwise, FEMA does not easily allow optionally convertible instruments, but startups have the unique benefit of issuing this optionally convertible instrument in the form of this convertible note. Second is the relaxation in external commercial borrowings, primarily the end-use relaxations. And thirdly, relaxations in opening foreign bank accounts. Labor laws, you can be self-certified. Environmental laws can be self-certified. If things don't go well under the IBC code, the startups have a fast-track winding up process of 90 days. And shares with differential voting rights are permitted under the SEBI regulations. And there are SEBI regulated angel funds or AIFs that can invest in startups. So there is also a pool of capital through angel funds, which are SEBI regulated AIFs that can directly invest in startups. Intellectual property benefits are lower patent costs, lower trademark costs. Trademark costs are almost 50% lesser. On the GEM government portal, your public procurement norms, you get relaxation as a startup where you are exempt from earnest money deposit, EMDs, plus the prior turnover or criteria experience requirements. So they relax all of these for if you are a recognized startup. Tax ones were covered, and some of these startup cells or email IDs exist for startups should you face any challenges. Some of the yeah, I think I'm going to skip a few slides just for the ability to cover our content within the time. This slide is something that I'm quite passionate about, and something that practitioners can see together in one go. As a company and an early company, it goes through varied stages. It incorporates, there are friends and family who join in, who give in that initial equity. There are incubators, accelerators, mentors, advisors who then come in, angel investors who come into the company. If the company matures further, it goes into raising capital from venture capital investors, larger investors called private equity investors, and ultimately sees a liquidation event in the form of an exit, IPO, merger, selling of all of the assets, selling of its IP, and different forms of business being sold or realized in value. During this journey, there are within each stages opportunities for us and varied opportunities. So at incorporation, creation of the company, creation of founder agreements, creation of equity structures at the time of incorporation of the companies where there's a lot of work to do. When friends and family come in, money comes into the company. There is these convertible instruments that get triggered. Once you go to advisors, accelerators, mentors, angel investors, complicated instruments in the form of CCPS, CCDs, etc. come in. There are shareholders, share subscription agreements that typically get executed. In case of foreign investors coming in, FEMA becomes applicable. And there are varied constructs of the shareholding between primary and secondary shares. Primary meaning money into the company, and secondary meaning transactions between shareholders. The idea here is, obviously, as chartered accountants, we would have our strengths, but to work with peer professionals, lawyers, company secretaries, who may have better knowledge and experience in these things, but to become from your end a trusted advisor to your client and work with other professionals to make sure this happens for the company. So it's I would say, co-learning process versus what you see as co-working in startups, and where they're usually found. Co-learning, where you're going to be able to do many more things with peer professionals and obviously help your company. Go to VC deals, their diligence happens, supporting your companies in due diligence, supporting your companies in tax diligence, financial diligences, company law related diligences is one area of practice. Employee stock option plans come into picture. Putting in together ESOPs is a second opportunity area, and SHA, SSAs which follow, FEMA which follows. Valuation of securities is required under the company law, B, FEMA, and C, even from a tax law standpoint. And valuations are typically something that now chartered accountants and registered valuers can do. So one idea would also be to seek valuation as a registered valuer. Private equity is far more longer. You now start seeing exits, existing shareholders also being able to sell their shares. So there's secondaries, there's primaries, there's continuation of what's already happening, but at larger scale, and then ultimately the exit. So this whole journey spans usually as a timeline between 2 years to 7 years. So we have seen startups go through all of this, exit maybe in 3 years or lesser. Some typically take longer, 5 years, 6 years. Some take maybe 7 to 9 years. But 2 to 7 is the best average. And the idea of sharing this is that not within too long, but within a span of 2 to 5 years as a practitioner, you could be in a position to have seen this journey, worked across these line items, and do this not for one startups, but for the hundreds of startups that will come to you. India is an opportunity of startups. Obviously, you see today programs, not just now Shark Tank, but many more that are promoting entrepreneurship, and therefore the number of such companies will only continue to grow. There was one interesting policy that the government introduced, and this was all equity related. So what about debt became the question. And their lending to startups is now backed by the government of India. So the government came up with a program that was a National Credit Guarantee Trust or a trustee company that was set up by the government, which backs loans given by banks or financial institutions to startups. So these loans would typically be unsecured because startups are not in a position to give any security. And while they are unsecured, it is the government that was providing security or providing guarantee to the banks for the loans that banks were advancing to startups. So now this largely exists across all public or private sector banks. Banks are still developing processes or systems around it. It's not become so famous because maybe many startups are not going and borrowing from these financial institutions. But there exists this whole framework to be able to borrow money from financial institutions. In terms of structures, your startups could be either of the three. There is a common question as to whether it needs to be a private limited, whether it has to be an LLP or a partnership firm. What should the company be or the startup be set up as? So there, what you could let your clients know is that if the vision is to solicit investments, not now, but maybe 2 years later, 3 years later, then what would be right to start with would be a private limited structure. Because drawing capital from investors, institutions, domestic or foreign, is possible through the shareholder structure or a shareholding relationship, and that is through a private limited company. A limited liability partnership would be more in the context of the company, not trying to think about raising capital, but being a startup, being profitable, being able to pay the 30% tax plus surcharges, and being able to withdraw the profits post-tax, right? So it's not necessary that you have to be a company that is raising money. You could very well be a company that is self-sufficient, that has its own source of capital, that is growing business, that is a startup, and that is then scaling and making profits and distributing those profits, and you're not interested in raising money. Partnership firm is also eligible, but yeah, and I'm sure you understand the difference between an LLP and a partnership firm in terms of limitation of liability. So that is where these structures of how these companies should be set up comes in. So going through what we were the opportunity matrix, which is to also further work in respect of various subsidies that some of the state governments provide, be helping on financial planning, things like MISs after investments, or MISs or tracking financial matrices within the company, allowing them to explore alternative financing options, getting them those collateral free loans, or enabling business strategies. Once the basic architecture is something that you're familiar with, that you have engaged with, there is an advanced level of interaction with some of these companies. I would call it the opportunity stack 2.0. So this 2.0 primarily first requires the 1.0 to be good. So as somebody who's stepping into this space, the ask would be still to be able to do the first journey, maybe the 2-year, 5-year journey process. And then there lies the larger opportunity or a more deeper and technical opportunity. So some of these words that you see here, these are key words, but I'll explain what the practice area is. There are term sheets, SHAs, SSAs required to be done. So you could be participants to investor negotiations and finalization of some of these investment documents, while they are also negotiated by lawyers or other professionals. Employee stock option plans, their implementation, their origination, and their execution. Convertible instruments and their way of investments, their conversion into equity shares ultimately, and their subsequent exits. There are concepts of bridge rounds or round of financing where there is no value discovery, but a floor and a cap construct is maintained, and how that could be something that the company can legally undertake. Diligence, which I mentioned, financial, tax, and secretarial diligence that the company would be subject to or would need, and they could be self-prepared prior to actually going there. FDI, ODI. ODI is overseas direct investment for those who are familiar under FEMA. The practice opportunity to work with your startup that is now expanding into global geographies. So they could have the parent company in India, and then they have subsidiaries in global geographies, and the ability to be able to help set up subsidiaries from India into those geographies. So A, FEMA, or B, the ability to work with local consultants in those geographies and help set up a subsidiary of your company in that geography. It is very common for Indian startups that have the potential to market their product globally to set up subsidiaries in foreign geographies. We have actually seen that happen with some of our companies. Cap table, which is a common word connoting the shareholding structure of the company. And this cap table also has nuanced calculations in terms of discovering the price per share, the dilution in the company, which is the equity that we dilute in each round as the money is raised. The classification of cap table into equity shares, CCPS, CCDs, convertibles, OCDs, and sort of varied exotic financial instruments. So a lot of this opportunity stack 2.0 is still there within the deeper ecosystem to work with and engage on. Some of the common problems that we have observed with these companies is what we have shared next. Again, the area of opportunity. The company is taking loans from individuals who are not shareholders. You can't just take loans from anybody. Their compliances or filings may not have been accurate or timely done. So there are defaults on the traces or tax portals. The interests with the loans being given or charged or advanced, but without giving interest, considering a lot of employee costs primarily as P&L costs and not capitalizing them as intangible assets, something that AS26 requires. Not filing 15 CACVs for foreign remittances or making foreign payments through credit cards, but which are not subject to 15 CACV or withholding tax compliances. Directors, negative balances, which is giving some loans to directors sometimes because they need to make some payments. So it's ideally a reimbursement, but showing as a loan given to a director, which is not permissible under the company law and therefore requires some fixing. Not necessarily the best maintained books of accounts or cleanup that typically happens during the time of diligence or prior to diligence, not filing the tax returns on time and therefore losing out losses which they otherwise would have had the benefit to carry forward and set off against future profits. Not having received exports proceeds for roughly more than 180 days. So a lot of these things which usually companies as they set up their business but overlook in the larger interest of being able to scale the business, and where you are able to come in and solve for many of these items. One other participant in the ecosystem are investors. And some of these, and this, let's say, I would say ultimately is opportunity stack 3.0. So it didn't finish with 2.0. Now this is 3.0. 3.0 is primarily the ability to work with investors who are investing in such companies. A is to work with startups, early stage growth companies. And B is to also have the opportunity to work with investors, institutions that invest in such companies. And who are those? A, they are foreign funds or investors. B, they are alternate investment funds, SEBI regulated AIFs. I'll spend about 3 to 5 minutes on the SEBI AIFs and the opportunity there. Venture capital private equity funds, which are typically in India structured as alternate investment funds. Angel investors, individuals with repute who have also good check sizes for investments, incubators, accelerators, family offices, a very new emerging investment asset class where they are investing in, again, a family that has made wealth but investing in companies of this nature. So this becomes the larger system of people participating through capital. And the AIFs are alternate investment funds, which are roughly 1,500 today, plus being registered with SEBI. These AIFs have come up in the last 5 years. There too, there lies opportunities in working with them from a SEBI compliance, from an AIF SEBI compliance perspective, tax calculations for AIFs, tax filings for AIFs, audits for AIFs, mandatory valuations for AIFs as per SEBI guidelines, and that too from registered valuers. AIFs and their relationship with their LPs, who are called limited partners or investors in AIFs. So there is an AIF, but the AIF itself is also backed through investors, and therefore the relationship with the LPs and the nuances around tax, FEMA, corporate law under the AIF framework. And because this is, let's say, newer group of asset class, there is a significant amount of professional help that is being required by some of these type of entities. Sorry, just give me a minute. All right. So what I wanted to do is, apart from the technical aspects that we covered in the first 45 minutes odd now, I wanted to actually tell you things that have happened in real life. All right. So this is company C. It was an e-commerce company which had investment backing and primarily investments from China, in their early days. Then happened COVID, and during COVID, a notification under FEMA was issued that no FDI would be permissible from border sharing countries, and China happened to be one of them. Now, this startup that had been backed by these Chinese investors could not raise capital due to this particular regulation. However, in the notification, and as you would have seen before, it was FDI that was restricted, but a convertible note was allowed to the startup. So what happened during that time in COVID is we as advisors worked with the bank, discovered the product, not discovered actually, mentioned about the product to the investor, got their comfort, went to the AD bank, mentioned to them that the regulations say FDI, what we're doing is convertible note. We are permitted to do so. We are a startup and we could do that through the regulatory framework provided, and ultimately received dollar capital from a border sharing country through a convertible note, and that helped them pass through that phase. And today the company is continuing to do better and grow. So how a convertible note instrument to an eligible startup helped at a time when they would not have been able to do so otherwise. Second is a company that was a fintech company for insurance. They had the 80 benefit. They opted for 115BAA, so they lost the tax window, but there was no heartburn. What happened was their employees could exercise stock options, not pay tax for 5 years. These stock options were held for by them. 3 years down, the company saw a liquidation event, and in such liquidation event, the stocks were sold. Now, what happened was the fact that they could enjoy the stock to be held and therefore qualify for long-term capital gain because they held it for more than 3 years and not have to pay tax at exercise. So it's a double benefit. Yes, they would have to pay now tax as perquisite and then claim the capital gains tax territory, but the benefit was being able to split between the holding period because they could exercise a stock and not pay tax. Angel tax obviously now is completely finished. ECB, there's a designer kids brand. They had good funding from overseas investors. Now they didn't want to dilute further equity. And the limitation was that if they were to get more capital, then they would have to dilute equity. But came in the ECB regulations, which were relaxed for startups. So because they were a startup and because they had a easier framework and end use restrictions were lesser, minimum average maturity loans were lesser, they had no capping on interest rates, and because of the slew of benefits, they were able to take external commercial borrowings, which is ECBs, from foreign investors into their company in a far more relaxed manner as compared to any other private limited company in India. Then there's another company, let's say that wanted to, it was set up. It wanted to raise money, both as equity money and as well as debt money. The founders obviously were very credible, and therefore they were investors who were willing to put both equity and debt. And again, the reason is that the money is needed, but the dilution is not what is being acceptable at that stage. And therefore, they were able to, because they were a startup, make shareholders, make them stakeholders or shareholders of the company, take equity money and also take greater debt money from them. Again, only with the fact that they could do so because they were an eligible startup. So the source of capital was not restricted. It became almost unlimited because they were able to use some of these benefits. Okay. Yep. So I think we're at 4:47. I wanted to leave roughly last 10 minutes for any questions or
Yes.
clarifications, sir. Right?
Yes, there are some
Yes.
questions.
Sure, sir. Just last 2 minutes.
Okay.
The idea to show this particular slide is unicorns, unicorns. Unicorns, obviously, $1 billion and higher. Unicorns are companies that are going to become unicorns. That's the, again, word there. But this particular list is endless. So you see these many companies today already at such a large scale. Many more that are joining this list of companies, and the opportunity therefore available. Now, Dimi, this was 1 hour. Should you have another 1 hour? There is an institute publication just where we had written in greater detail about this. You'll find it in this particular edition should you want to read anything technically. Some of these things have changed regulatorily due to passage of time. There may be some updates. You could just refer to more amended laws, but a lot of the conceptual framework still remains. The benefits are continuing to be added, and I think as practitioners, a lot of your clients can get benefits from this. So thank you for patiently listening throughout, and I hope this was useful to all of you. These are my contact coordinates. Yeah, thank you, and look forward to having any questions that I could address.
Yes, there is some questions.
Sure, sir.
First question is, what benefits are for a startup and how to avail?
Yes, so the benefits were here. Like I said, the tax and regulatory benefits. The tax benefits is something that we had discussed. So anything from the tax side, a lot of them were capital gains, ESOP, the ATS, carry forward, and set off of losses. And the non-tax benefits are under company law, FEMA, labor law, IBC, trademark, public procurement, etc. How to avail them? The Startup India recognition is what you need to take, the first one, and then get the interministerial board recognition for the tax one. So I think that's the whole setup of how to go about doing it and taking it.
Okay. Second question is, can we have this PPT?
Yeah.
Okay.
Sure, sir. We'll send it.
Okay.
My only would bear with me just for factual updation because of change in law. But I'll send this one as it is.
Okay. Next question is, can a company start manufacturing of garments and textiles made of can be treated as new startup for above?
Yes, it can be. What the company is doing is manufacturing garments and textiles. While we may think traditional, there is absolutely nothing traditional about it. Manufacturing as a sector will generate employment. it will create wealth, it will qualify as a startup. What has to be taken care is that the machinery used for manufacturing, that should be something that is new and bought. It should not be a second-hand purchase from any existing company or just some other manufacturing facility. May say we are buying out some machinery. So please avoid that. Set it up as a new business, as new infrastructure, and you can certainly get it recognized as a startup.
Okay. Next question, kindly explain ESOP for tax deferment and related aspects.
Okay. I'm just trying to find this. Okay. So ESOP tax deferment. Firstly, ESOPs are employee stock options. ESOP employee stock option plans. Now, in the Income Tax Act, Section 1726, primarily says that the ESOPs are to be taxed at the time of exercise of stock options. Now, these are private companies and their shares are usually not listed, obviously not listed, but not liquid as well. So, exercising a stock option and then being able to sell it is the challenge. Now, if I were to exercise and pay tax, then I'm not sure whether I will discover a selling value for my shares. What would till now happen is no ESOP would be exercised unless there is a standing buyer. That was the previous pattern. That if there is a buyer, only then will I exercise because I need to pay tax and simultaneously sell my stock, which worked well. But that was obviously at a disadvantage. Now, with this benefit, I could exercise a stock and not pay tax, own it, keep it. Let's say I've owned it, I exercised it when the value of the company was 100 crore. 3 years have gone by, the company is now worth 400 crore, and then there's a buyer for my shares. I could now do two things. I could now exercise, I could now sell the shares, pay tax on the first 100 as perquisite tax, and the next gain between 400 to 100, the next 300 crore gain is what I could offer as long-term capital gains tax because my holding period has now exceeded 2 years because I own the stock. ESOP again would not give me the holding period benefit unless the stock is owned and exercised, not just as an option. So what this helped is to break pay no tax, own the stock, hold it, sell it, and enjoy the territory of long-term capital gain. So that's uh, the detailed benefit of this ESOP tax deferment.
Okay. Next question is, are there any exemption on stamp duty for acquiring immovable properties?
No, not something that is not central in nature. But if the particular state policy for promoting startups is providing these exemptions, I would just that would be the additional check, not at a central level, but at the state level within the state policies, if there is any benefit to a DPIT recognized startup for stamp duty.
Okay. Last question. Company manufacturing T-shirts and selling it on e-commerce. Investment 50 lakh, employed 500 people, can take tax exemption.
Oh, investment 50 lakhs and employing 500 people. Very good. No, can you take tax exemption? Yes, no problem. The company would, so they're talking about the interministerial board exemption window. Criteria: first, become a startup. So that's barrier one. Two, turnover not exceeding 100 crores. The fact that you say 500 people are employed. So I'm sure you're sizable, but not sizable, but don't be sizable enough to cross 100 crore. If you have, then you're not eligible. So I'm assuming they're less than 100 crore in revenue. And then you're set up after 1st of April 2016. Right? That's the entry point. With these criteria, you can apply for your interministerial board recognition. Your criteria matrix is then otherwise good and no other problems. Whether you get it or not is a subject matter issue because it's the business of manufacturing t-shirts and selling them online. So is there anything that is different about it? So that can be the limitation of not getting it, but give it a shot. No wrong in applying.
Okay. Thank you, CA Shankam Shah, for a very informative and insightful presentation. Thank you very much, sir.
Thank you. Thank you, Rakesh. Thank you.
Now we will now proceed to the second technical session on compliance under the Code of Social Security 2020. For this session, we are pleased to have CA Chetan Agarwal from Jaipur, who will guide us through the compliance framework and practical implication of the code. The biodata of Chetan Agarwal is so. He is a qualified chartered accountant and member of ICAI with graduation and post-graduation from Rajasthan University and has 4 years of specialized experience as a labor code consultant. He has strong expertise in Indian labor legislation, including the Industrial Dispute Act, Soap and Steps Act, Factories Act, Contract Labor Act, and New Labor Codes and Social Security law, and has played a key role in labor law audit for major corporate and non-corporate clients. He advises organizations on labor law compliance, HR policy drafting, station register and return, and represent employer during labor inspection and proceeding. Ensuring practical and risk mitigate compliance solution, he is now actively involved in training students and professionals on labor law and payroll compliance with a focus on simplifying complex legal provision and their real-world application. Thank you, Sichan, for your valuable insight. Now, I request C.A. Chetan Agarwal to kindly take over the session. Unmute, sir.
Thank you, sir. Thank you so much. First of all, I want to express my sincere thanks to our chairman, sir, Satish Gupta, sir, Vishnu, sir, Rakesh, sir, and of course, audience. Now, our topic is compliances under Code on Social Security 2020. Actually, in our previous sessions, we have already discussed that key changes which derived from implication of new labor codes, which are code on wages, code on social security, industrial relation code, and occupational safety, health and working condition. So now we will discuss a little about key changes through the act itself, and later on we will discuss what are compliances we need to do, or what other regulatory actions or inactions which are mandatory for an employer. So broadly, we will see the Code on Social Security 2020, what arrangements are made by the government in the act. Okay, so we will discuss only in 5 minutes, 5 to 10 minutes, the key changes or the chapters which are included in the act. Actually, there are total 9 acts which are we can say subsumed, or we can say merged in the Code on Social Security. The 9 acts, that is PF Act, Employees Provident Fund and Miscellaneous Provision Act, ESI, gratuity, maternity benefits, and of course BOCW. And there are some other 4 acts: unorganized worker, employment exchange, etc., etc. So in first chapter, only short title, definition, etc. are given, and of course the one important thing, that registration and cancellation of an establishment is also given in chapter 1. Okay, so it means that the whole chapter will apply on an establishment or an organization through the chapter 1. Okay, so let's suppose if we discuss about pre new labor code scenario, where all the acts are separate. So if on an establishment, if let's suppose ESI act is applicable, okay, but PF is not applicable due to not reachable to the number of employees, that is 20, or other regions, some act is not applicable. Now if the provisions of applicability or provisions of registration is given in section 1 only, okay, so the whole code will apply through chapter 1, and all the acts, all the previous acts which are merged in the code on social security will applicable on such establishment, that is PF, ESIC, gratuity, maternity benefits, etc. All the provisions of the previous acts will applicable on an organization through single registration point or single applicability point. The second chapter deals about social security organization, under which government describe the constitution of trustee boards, etc., welfare boards, and other trust funds related to PF, ESIC, gratuity. The chapter starts from chapter 3. Okay, the code starts from chapter 3, starting PF provisions. So all the provisions of PF Act, earlier we can say Employees Provident Fund and Miscellaneous Provision Act, all the provisions were summarized and fitted in a chapter, that is chapter 3. So in this chapter, maximum even 99% provisions are same as earlier, like PF will be applicable on 20 employees, the contribution will be 12% for employee, 12% for employer, the applicable limit, wage limit for PF is 15,000, etc. There are some other provision like for bigger organizations, the trust can be created. The fourth chapter is for ESIC provisions. Still, again, all the provisions, or we can say maximum provisions, are same as earlier. There are some new provisions which are inserted in the ESIC applicability, that voluntary registration is now available under ESIC. Not now, but after implication of the code, that is in market, there are some news that from 1st of April the whole code will be applicable. Actually, right now rules are yet to come, so we can say that the whole code is not applicable right now, but definitely from 1st April government is trying to simplify it, or trying to implement all the rules. Definitely, in my opinion, from 1st April, the code or rules will be implemented, and whole code will be applied. So later on, when the code will be applicable, made effective by government, ESI, voluntary ESI registration will be available, and also government also provided that in some industry, that is we can say in the nature of hazardous, etc., government provided that ESIC registration limit will be for one, that is for single employee, the registration under ESIC will be mandatory for that organization. That list will be notified by the government later, not yet notified, but on these establishment or these organization, ESI will be applicable irrespective of number of labor or number of employees. Rest things are same until the government changes, that is total contribution will be 4%, the limit for ESIC will be 21,000 as earlier, same as earlier. There are a little change in the ESIC applicability wages, that is earlier the ESIC is applicable on gross salary, gross pay of employee. Okay, the gross should be up to 20. If gross is up to 21,000, then ESIC will be applicable. Otherwise, no. But now the government also changes the definition of wages under the Code on Wages Act. Okay, so now government only included if you have taken my session or even some other lectures, so you will be definitely aware about the changes in the definition of wages that the government changed. Now the wage definition will be basic plus DA plus returning allowance, and other parts will not be included. There are some other explanation we will discuss later. If you have any query, you can personally message, or we will discuss at the end of the session. So now applicability may be changed, but right now the department, ESIC department is are also notified, also published that until the new rules uh, new rules are implemented, till that you have to comply through old provisions only. Okay, so right now if I say that the what is the provision right now, so I can say that only 21,000 gross salary under ESIC. Rest provisions under ESIC are majorly same. Next chapter is for gratuity. Actually, there are also some changes under gratuity. That is a new term, fixed term employee, is also added under new labor codes, that is under industrial relation code, and also used in code on social security. Fixed term employees are those employees which are hired or which are appointed for a particular time frame, that is their engaged time is fixed or certain, we can say. Not for that is not like that up to completion of a project, but we can say that from 1st of Jan to 31st December, or from for 3 months starting from 1st of April. Okay, so fixed term employees now eligible for gratuity even after for completion of 1 year service with any employer. If we discuss earlier provisions that gratuity will, an employee will be eligible for gratuity only after completion of 5 year continuous service, but in case of fixed term employees, he is eligible only after 1 year. Okay, so that is a major change. Also there are some confusion, or we can say misconception, that gratuity is now available, that is 1 year limit is available for all the employees. No, only for fixed term employees, and the fact of such fixed term employee should also be mentioned in their appointment letter, that the particular employee was hired for a particular period only. There are some little changes also for gratuity, that for a working journalist the time limit of 5 year is replaced by 3 years. So now that journalist will be eligible for gratuity only after 3 year continuous service. Rest of the provisions are again same as earlier. Next chapter is chapter 6, maternity benefit. Maternity benefits now fixed and of course made strict, that employer should compulsorily provide maternity benefit of 26 weeks. Okay, so in previously if we discuss previous provisions, so there are some different provisions in each state. Okay, but now government through maternity benefit act codified the same provision, that every employer should provide at least 26 week maternity benefit for a female employee. Also, there are some changes such as crèches facility. If an organization having such number of employees, so the employer should also provide crèches facility, nursing breaks, etc., etc. There are some other provisions like forfeiture of maternity benefits. In what circumstances maternity benefit can be forfeited. Also, applicability when a female employee is eligible for maternity benefit. Next chapter is for employees compensation. So again there are many maximum same provisions such as in case of accident, in case of some mishappening, death, injury, what will be the compensation, what report and what process should be followed by employer, what returns should be filed by employer, what other conditions to be fulfilled by employers. Next provision, that is chapter 8, is for BOCW says. Actually BOCW says is again mostly same as earlier. For any employer or even for any person, we can say, if he is constructing any building or arranging any building installation, etc., repairing, revocation of any immovable property, so he has to pay 1% of BOCW cess, earlier known as labor cess, to the respective government. Okay, so under BOCW also most of the provisions are same as earlier. That is 1% says should be deposited. If there are any late payments, so 24% interest will be levied, self assessment of sales, etc., etc. Okay, so main provisions are contained up to chapter 10. Okay, so in chapter 9 there are some new provisions added such as social security for gig workers, social security for platform and unorganized workers. So under this chapter, the government introduced a social security fund and gig workers fund, or also specify the process to be done by an employer for social security of such workers, that is unorganized gig workers, platform workers. Also government also mentioned under this chapter that the process through which the benefit to be provided to such gig workers, such unorganized workers, through a common portal. Government will uh, definitely launch soon the common portal for registration of such workers, on which such these type of workers need to get registered himself, and government will announce benefits for them. Okay, and next chapter is chapter 10, which is related for finance and account. So chapter 11, 12, and again rest chapters are for some procedural part, some audit and inspections part. Major implication or major changes are covered under only up to chapter 9. Now we will see through our PPT. Okay, so introduction to the code on social security. We have already discussed the key changes. Of course, we have taken earlier 2-3 sessions on code on social security. for key changes, and of course now we have already discussed the main changes. Now, what provisions broadly taken into code on social security, and what are the impact? Okay, the first one is universal coverage. We have already discussed in starting that the code will be applied on an organization through chapter 1, that is through section 3. Okay, employer need to get registration under code on social security as per section 3. Of course, if an employer is already registered, then he has not to get registered again. So their earlier code will be converted in the code on social security registration. Now the major implication is that the code will be applied on all organization, that is all the previous act will be applicable on an organization, not one by one. Okay, earlier all there may be instances that ESIC is applicable but not PF. Great, there may be instances that gratuity is not applicable, employment exchange is not applicable, BOCW is not applicable. But now all the chapters will be applicable to an organization. The limit, of course, right now we are considering that the limit will be 10 for applicability of code on social security. Still, sorry, rules are yet to come. So we will finally construe that exact amount of limit or exact amount of employees only after implication of notified rules. Okay. Second point is that comprehensive benefits. Of course, the code merged all the 9 acts, so the benefit under all these previous 9 acts will be merged, or we can say that the employee will get comprehensive benefit under one act only. Okay, earlier if an employee need to get benefit under ESIC, then he has to get his registration through employer under ESIC, again for PF, in PF. Now if employee is registered under code on social security, so automatically the benefit under PF, ESIC, gratuity, maternity, etc. will be given through comprehensive mode. And of course, modernization, streamline compliance through digital platform. Government will definitely launch soon a portal dedicatedly for seamlessly implication of such new labor code. The aim behind these all four new labor code was that government is planning that employer only need to file a single return under all four codes, and employer need to take only single registration. That is, government is planning for compliances purpose that a unified portal will be launched, and so that compliances will be easy for an employer also. And of course, these new labor codes are, we can say that worldwidely affected, and of course these are also made, we can say, in through the through taking the points of WTO. So we can say that globally impact will be there for these new labor codes. Next is employers' obligation under the code. What obligations are made under the code on social security for an employer? An employer first of all need to register all his eligible employees under the code. Okay, we are using the term eligible. Actually, we all know that for PF there is a limit of 15,000 basic salary. For ESIC, I'm talking about earlier situation. That is before such labor codes are come. Earlier, ESIC limit was 21,000. Actually, right now also, bonus under bonus act, the limit was 21,000 basic salary. So if an employee is fall under such limit, of course the limit will also be available under such these new labor codes. There may be changes in limit, government is also planning to raise the uh, limit of PF, limit of ESIC, just because uh, last in 2014 the PF limit was changed from 6,500 to 15,000. So from 11 years the limit is same, that is 15,000. So government is now planning that it can be 25,000 or whatever, what the government will fix, we will finalize that time. So an employer need to get register all his eligible employees under the code for their social security, for their returns filing, for their compliances purposes. Okay. Second is timely contribution deposit for for all eligible employees. Employer need to file their returns on time. That is, uh, returns will be only will be submitted only after contribution is deposited under PF Act, under ESIC Act, or let's suppose if some employees are exited, then he has to employer has to provide gratuity or other benefits as per applicability. Pension depository, employment depository, linked insurance. Pension and EDLI are also deposited with PF only. The time limit is same also under new labor codes, that is 15, which is same as earlier. So employee need to get the registration of all the employee. Also, employee need to deposit contribution on time. Third is, sorry, employer need to maintain all his records accurately, and of course complete record should be maintained by employer. The records are very crucial for employers. That is just because at the time of inspection, authorities, that is PF authority, ESI or labor inspector, whatever, so they will demand the accurate records, complete records. And if the records are missing, employer can face legal implications. He can face notices, he can face demand orders, etc. So employer, we can say the document or records keeping is very crucial, or employer need to definitely follow the definitely keep all the records. There are there may be a chances that in accounting, same like accounting, there may be government can launch that there may be some internal audits under labor law for big organizations. So at the time of such, if there are these provisions are implemented, then also at the time of such internal audits or such other audits, records are very crucial. Next is provide benefits promptly. Okay, so employer need to disburse the social security benefits to every eligible employee, and of course he should not delay any delay for disbursing social security benefits such as PF, ESIC, gratuity, bonus, whatever the benefits are, employer should provide on time. Otherwise, again he can face notices, he can face demands, or he can face the legal liabilities. So these are some obligations of employer. Next is compliance monitoring and reporting. So under compliance monitoring, we already discussed that monthly returns, quarterly returns, half yearly returns, and annual returns under some acts. So employer need to file their returns on time, that is monthly, quarterly, half yearly, and whatever the time limit. Periodical audit, that is not statutory audit, that is recommendatory, or some we can say that for compliances purpose periodical audit. Still not any statute recommend that an statutory audit should be done under labor law, except for some exempted organizations such as PF trust or ESIC trust or gratuity trusts. These trusts are monitored through third party audit by PF department. So periodical audits should be done by employer uh, in a fixed interval, let's say quarterly, let's say half yearly, as per their requirement or as per the size of the business. Digital trading in today's environment, today's era, there are many AI or many tools. So these tools are very real time real time monitor the compliances or real time monitor the reports. They also check the known compliances or the impact of the, of course the whole MIS are also available through these tools. So need to digitally employee need to uh, digitally good, and of course he has to follow these digital tracking devices or tracking tools, so that uh, all the known compliances or all monitoring should be on time. Known compliances alerts are also provided by such governmental portal or through or other private, or we can say some HR tools, through some HR tools. PF portal also alert if we not file ECR on time. ESI portal also send messages that your contribution is not deposited. Some there are some HR softwares, HR tools which are also uh, get provide alerts that your compliances are not yet done. You have to file on time, otherwise the penalties or other liabilities may occur. So an employer should also aware about these automated systems triggers, so their compliances monitoring can be proper, or proper reporting is possible. Next is audit and enforcement mechanism. There should also be some surprise audits by the HR teams or by the concerned person or concerned officer of the organization, so that he can assure himself or he can assure employer organization that all the compliances are on time, all the process are uh, being followed properly, all the employees or all HR team or other responsible person are working properly, all the reports are on time. Let's suppose if HR or other person employee uh, uh, something do some unethical practice such as wrong attendance, etc. So in surprise audit, these legs can be defined, and of course these legs can be identified and should be and corrected. Finding documentation, detailed audit report outline compliance status, identified violation, discrepancies, etc. are also documented, so that we can improve the system or we can improve our compliances. After finding the lakes or after recording, it is same as just like our audit, like a audit documentation. We keep records like audit document. So if we find or we documented any leaks, so we can take proper corrective action. If we don't have any documentation or we don't have any proper record, so there are certainly chances that corrective actions are not taken properly. Legal enforcement are also, that is, if employer is not doing compliances properly, he can face formal notices, court proceedings, outstanding due demands, of course, bank attachment, assets attachment, etc. So these are some audit and enforcement mechanism an employer need to follow or to comply all the provisions of the code. Handling non-compliances and penalties. So there may be a chances that a non-compliance is being a non-compliance has happened in an organization. So now what to do? What should the corrective action to be taken by an employer for non-compliances, or how to handle non-compliances? So there are many options. That is, first of all, for an employer, we can say that an employer need to or try to follow all the provisions or all the compliances timely. So first of all, we can say that employer need try to comply with all the provisions, and so there are little chances of non-compliances. If still there are any non-compliances, so in major acts, or we can say that in every act there are option of filing arrears. Okay, so in PF we can file arrears, PF deposit. We can, in ESI we can also deposit omitted wage amount. Uh, if we have not paid gratuity, we can pay now with interest. If we have not paid bonus, we can pay with interest. So there are first option is that we can pay through arrear uh, amount. Okay, so arrear installment agreement allow employer to regularize their outstanding due. Okay, that the first is for employees purposes. If there are some departmental due, okay, there may be a chances that let's suppose PF department issued demand order of 10 lakh. Okay, for a small organization, there may be asked to pay 10 lakh. So the employer can pay with installment also. Here also, employer can pay in installment. Department allow them with 6, 10, 20 as per their agreement. So he can pay in installment. Next is to fight if he thinks that he can get resolution in appellate section, so he can file appeal in higher authority, and provide their suggestions, provide their records that there are chances that there may be some demanded which is correct, and there are some demands which are unusual or which are not correct. So he can face appellate. He can prefer appellate authorities options. Next option of handling non-compliances or penalties, that settlement. Okay, there is a option of settlement with every department, that he can settlement, or we can say that he can pay a fixed amount in place of actual demand order. So he can uh, deposit only that settlement amount, and he has to promise that he will again he will never do non-compliances again. Next is he has to monitor compliances management system. He has to implement the compliance management system. So the system will at real time, the system will uh, alert him that such non-compliances is happening. You can stop, or you can uh, make it correct. So these are some options, or these are the way an employer handles non-compliances. Of course, interest and fines are also imposed if demand is not paid, tax is not deposited on time. Criminal prosecution can also be initiated by the department, not by the department itself, but by the some judicial courts, or some higher through some higher courts. So this is an example of a case study that effective compliance management system, how an compliance management system uh, performs. Okay, so if an employer implement the effective compliance system in their organization, so that compliance system integrates their records. That is, the system automatically integrate all the records which are necessary for inspection, necessary for audits, and necessary for other filings. The compliance management system should uh, also provide alerts to the proper authority that such non-compliances are happening. If there are something missing in process or in document, the system should also provide alerts. The effective compliance management system should be like the process or workflow should be streamlined, or should flow properly without any break, without any uh, blockage. If we if we if we do if we implement compliance management system, so if we measure the report cards of the compliance system, so we can find that 95% plus compliances are to be done automatically through such system. Okay, so there are a very little chances uh, of inspection, or to issue demand notices, just because we have already done all the compliances, we have already submitted all the returns. In totality, we can say that if we implemented the proper compliance management system, we do not need to worry about the compliances. Role of technology in compliances. In the today's era of AI, the departments, government also uh, taking helps of such technology. We all know that income tax department have many softwares which automatically retrieve data. GST department also have high tech softwares. So now labor department or social security department also have such proper technology. Employers should also focus on technology, so that their uh, their time will save, and of course it will be helpful in cost effective. Employers should follow analytical tools so that their compliances risk are uh, compliance compliances risks should be mitigate, or it also provide the AI tools or analytical tools also provide patterns, predicts proper compliances system, prevent any known compliances or unethical process or illegal process. These analytical tools also prevent errors, okay, human errors we can say. So employers should focus on technological and also take help of technology. There are many softwares uh, which are run through AI or through technology. So these provides a streamlined flow of compliances, and employer need not to worry about anything for compliances. Government also focusing such technological improvement that government announced at the time of implementation of these new labor code that government will very soon launch portal, uh, unified portal for uh, registration, single registration, for single returns, for welfare of gig workers, welfare of unorganized workers, etc. So uh, the technology helps in such things such as digital portal, analytical tools. Also, there are some training support available. Now, what are the benefits of compliances? Of course, there are uh, these helps in proper benefit, or we can say that proper social security of employees. So employees will get motivated. There are of course cost avoidance. Employers prevent their legal cost, reputational damage, of course, and management attention. Productive workforce. If the employee is properly motivated, then he will be productive. Uh, he will also work more than his capacity. Workforce security, if we are providing proper benefit to employees, then labor turnover ratio will be less for in compared to other organization. Or if we are following all these, so our reputation will also increase or enhance. So we can say that the stakeholders will also recognize for our efforts. Now, conclusion is that employer need to follow all the compliances of not only code on social security but also other three codes, that is code on wages, industrial relation, and occupational safety, health, and working condition. Employers should be proactive in adoption of compliances, not that at the generally what employers do, that at the time of notices or at the time of demand orders they focus on compliances. Employers should be proactive when a new law is implemented. Employers itself should follow compliances, so that they can uh, provide better proper social security to employees, and of course proper contribution to the nation also. And there should be of course transparency in reporting, so that accurate and proper data is kept, and there should be no harmful or no other legal liabilities at the time of inspection, etc. So it's thank you so much. Now there are only 15 minutes left, so we will discuss queries, or if you have any question,
Yeah.
You can ask.
Yes, sir.
Thank
Thank you,
Thank you,
C.A.
sir.
Chetan Agarwal, for your valuable insight. Since there is no question raised by participants, we shall conclude the session. As we approach the conclusion of today's webinar, I would like to thank you, learned speaker, for sharing their knowledge and all the participants for their active presence. With this, we conclude today's webinar. On behalf of the CPE committee of ICSI, I thank all dignitaries, speakers, and participants for making the webinar a success. Thank you very much.
Thank you, sir. Thank you so much.